The Wyckoff case for new stock index highs. Can the stock market, the S&P 500, the Dow, the NASDAQ comp, the NASDAQ 100, can they make new highs above the bull market peak of 2021? That is our discussion for today. And welcome to Power Charting. I am your host, Bruce Frazier. Thank you for being here, my dear Wyckofian friends. Today we are recording this on the 14th of November, which is actually C.P.I. reporting day. This is a Tuesday for Friday release. So keep that in mind. Part of the reason that we're looking at point and figure work because it's a little bit more durable in multiple time frames. But please keep that in mind, and let's get started. So the first thing I would like to do is to have a discussion about bonds. And you may have noticed that I wrote a blog here recently, a little over a week ago, and please go read it if you haven't. This chart is in there. This one you're looking at is updated. And this is the 7 to 10 year US Treasury bond ETF, symbol IEF. And it is our proxy for, let's call it the 10-year US Treasury bond price. And it is a really classic Wyckofian chart. And so let's just take a really brief look at this. And you will note that in you Wyckofians, let's see if I can get yeah, here we go. We'll note that we had a big decline with climactic characteristics that occurred in two steps here, big gap, and then a selling climax. This throws under the bottom of the channel. The channel is anchored by these points here and here. This is the stride of the market. See how it's set so early in the decline. This is after a distributional structure. This is a redistribution because if you go out, stretch this chart out into a longer time frame, you will see that there's a big downtrend occurring. And the has a pause, builds a cause, and then goes into a new downtrend. The big tip off in this chart is the sign of weakness that occurs, and then an attempt to rally, which is a completely flat structure with actually another new low in it. And this is called ice. And ice is when you have a period where you get under key support, cannot rally, there's no good demand in the price of the instrument, and in fact it has no good sponsorship by the composite operator types, and it can go into a new downtrend. That often happens at the conclusion of redistribution or at the conclusion of distribution also. And so we expect that at the conclusion of a decline, we're going to get the selling climax. We had one, we had a throw under here and here. That is coming out of the bottom of a downtrending channel. This is a classic oversold condition. We use the charts themselves to establish overbought, oversold using trend analysis. It's a fantastic example of that. Keep this in mind as you look at the instruments that you trade after long uptrends or long downtrends. And so then the oversold condition dramatically is reversed by a rally. And I drew a little trend line under here because this is a valid trend line also. It's in gray. And you can see here that after it becomes oversold under the channel, it reverses back up, and look how quickly it is able to regain the entire width of the channel and become short-term overbought above the top of it, but then it just rides on the what we call the supply line here and rides on that supply line, and then today on this great C.P.I. news, no growth in C.P.I. month over month, which is fantastic news, good for the market, good for bonds, and it's a continuation of a rally that really began back in October. So that is our brief look. Let's look at the point and figure just real fast. And you can see here that we take account. This is a one box reversal swing trading count, half point box size. And we take this count across this area. Look, we have the sign of weakness here, and then a attempt to rally. Here's our ice forming, and then more signs of weakness, downtrend. This downtrend is formed here, and here we can draw downtrending trend lines on point and figure also, in addition to being able to draw them on vertical charts, and they will be slightly different. Note that this has not yet come up out of this downtrending channel yet, and is currently this chart, because this was on November 3rd, has gone up to 92.50. And I put a little arrow there to show a pullback and a rally, added another column of O's on the downside, one down, and then an X up, not out of the channel. I expect it will get out of the channel. Here's this beautiful Wyckoff trifecta of a oversold condition after a long decline with a selling climax, and also fulfilling a distribution down count. So that is a beautiful trifecta of events. We see that all the time in Wyckoff. I've shown you them here and on the Power Charting blog a number of times in the past. They're beautiful when they form and set up the conditions for a sharp reversal, in this case upward. So there is a look at the IEF. Let's move on to our topic of the day. You saw this chart the last time we met, and this is the S&P 500 one box reversal, 20-point scaling, and this is a distribution that formed from June of 23 to September. This chart is actually of September 21st, and it looks like the completion. Let's put a little hinge in here. The completion of a structure that then resolves itself with decline. At this point, it was on key support, but the count appeared to have been formed. We took a count at that time, and that count gave us a 4120 to 4,000 downside count. I would just bring your attention to this reaccumulation count. I love this structure because look, it's striding upward throughout this whole period, resolves itself with a really good rally up to 45.80 at the highs. Well, look, our count here gave us a count 45.40, 44.20. It went a couple of boxes above the high count. Beautiful. And then threw over, and that was exhaustion. And then we built this local distribution. This is all swing trading, short-term local type activity. Now, what we really want to do is bring this up to date. And here is this chart through today, the 14th of November. And the same count that you just saw, 4120 to 4,000. We said last week when we showed the decline into the fulfillment of this count here that it was fulfilling the minimum objective and then turning off of that, which it has sort of the characteristics of a spring there and reversal. Very interesting. And that spring and reversal down to the 4120, I consider it bullish when you have a distribution count that goes to the minimum objective, cannot get to the maximum objective. And that's 4,000. It only got to the minimum. And then look at the veracity of the reversal upward that we have. Really beautiful. And the question becomes, can this S&P stride up to the highs of the bull market back in late 2021? And actually, we're going to do some oldies but goodies. some hits from the past. But first, let me show you this vertical chart, which again, this is updated through the 14th today, Tuesday. And you can see the deep throw under of the channel, which went right to critical support. And this is a support line that we drew a long time ago. And this support, well, this is resistance actually. This resistance line here becomes support here and pulls all the way back and kisses it from above and touches it and reverses sharply off of that. That gives us the notion that this, which we identified at the time, going back into 2022, you can see this is the June-July low of 22. This is the all important October low of 22. And then we have the March low. And this appears to be an accumulation type structure. And this rally up to the resistance and then stalling there without having any kind of a meaningful pullback was a very important tip off for Wyckoffians that this was a market that was in an upward stride and wanted to get away from the accumulation structure finally, all the resistance overhead, which held back the S&P 500 for many, many months. And we can see this really started to take effect back in May of 22 and then just kept imposing itself all the way through until this backup was taken out. And you can see the upward stride established by that secondary test and that LPS low. So really and then down we go. We've taken out this long-term 200-day moving average and the downtrending channel. Drawing channels is so important. And then had a very sharp reversal back up into the channel, reinforcing the upward stride of this rising trend in the S&P. This is encouraging for the bulls. Here is our bull market top. So, and this takes us up to about 4,800 plus. And we're asking the question today, can we get back there and go above that level? Another oldie but goodie here is to talk about, and this chart was created in October of 22. And this chart is incomplete. We said at the time that we thought that it could rally up to this all-important resistance that we just talked about, and then which was a count, and that it would stall there, which it did, and then pull back for another LPS type action that could build bigger cause. So that was just using the principles of Wyckoff, we were able to see the conditions for a potential accumulation while this was still in a demonstrably downtrending structure. So very interesting. And we talked about at the time how what we would need to see to say, okay, downtrend is over. Part of the reason we like this as an important low was because of sentiment. And sentiment was very bleak back then. Sentiment has served us so well over the last couple of years at the highs of the bull market, at the lows, and at subsequent lows, December of this last year, and then March of this year, and so on. And it's serving us again now. Oh, look at the mess I made. Let me clean this up. Okay, so now you can see that this count here became a little bigger and counted up to 43 and a quarter, 45.75. And so this count came into play later on. But look, this is that pullback that we expected from the 41.75 level. I guess it came in around 4,100, pulled back. This has an LPS type quality. Now we're looking at the conditions for accumulation with a higher low. So this is very, very constructive. So we really have three counts here that are at work. We have this small swing structure in here that counts up 43 and a quarter, 45.75, became very important later on, and I will show you this. This chart was drawn in January of 23 this year. So you can see this goes back pretty far. And always keep in mind, when we're making accounts like this, we recognize that they are unfinished, can grow larger. This one did, and that it could in fact be redistribution for another decline in this case, even though we have an orientation towards the potential for an uptrending action, at least getting towards the highs that we had back in 21. So here you see this 43 quarter, 45.75, but we also have segmented counts. So we have a 21 column count and a 37 column count. The 21 column count gets us 50.75 to 53.50. That's a new fresh high in the S&P 500 above the 2021 bull market peak. That's very compelling and interesting, but still we are not out of the structure yet. So this is a conditional count. And then also we have a count that goes 37 here, and this count takes us 62.75 to 65.50, getting us well above the 2021 peaks. So, excuse me, losing my voice, but this count could grow larger, could shift in structure. So let's look, and here we see this is a count from January of 23, 3-box reversal, and this is just a different look at this data, and this is 50-point scaling. And so you can see that also roughly confirms the count that we just looked at, but you can see how you can change scaling parameters and get similar objectives. And so note also how this peak count here gave us a beautiful count down to that 34.50 area off the bull market peak and distributional structure. Now, we want to bring this up to date, and we asked the question at the time with that black arrow, can we come out of that downward stride, all important downward stride? Well, here we are. This is a chart. This is 50-point scaling, 3-box reversal. This is an important count, an important point and figure. And you can see here now that we're looking at a much more complete structure for accumulation and a rally up and out. And so we want to count that, but let me just bring your attention for a minute to this reaccumulation count that we had. And this count here, which was part of the bull market, this is 2019, 2020. Look at the beautiful count that was formed there. And that count took us right up 17 columns up to 5,047.50, which we went to 4,800, which was striking the middle of that objective range. And that was the conclusion of the bull run. So now we have a decline in 22 and the structure we just talked about, which actually we said in the prior charts that the count could grow larger. We looked at those counts in January. Well, you have to look closely. Let me zoom in here. And you can see that we went, this is the January column, February, and then here's March. So we in fact got 2 more columns across here, widening out this count structure that we have. So I want to make it clear that we always consider these counts to be conditional because they can grow larger. And at the time, we still were wrestling with the idea that it could be a down count. Now, we have our biases and we prefer to think in the upward direction. I do anyway. But at the same time, we have to be objective about what we're looking at. very important to Wyckofian analysis and all technical analysis. And I know that you're looking at these downstriding conditions here, and you're seeing that beautiful downtrend and the breaking out of that downtrend. Very important to the bull case. And so here is the count across from March of this year, and this actually goes all the way back to June. So this decline occurs in June, end of the quarter, and this count is 22. This count across here gives us a count of 19, and times 50 times 3-box reversal, 2,850 S&P points of count upward objective. And now our bias is upward because we've jumped up and out, and look at how we've pulled back. Old resistance becomes new support, as we saw in the vertical chart. And you can see here that we've reversed off of that. Now we have headwinds. We have a beautiful count here that goes 6,350, 6,700 on this point and figure chart, which massively takes us to new highs in the S&P. But we have headwinds, and we have to keep these in mind. And that is that we have the headwinds of the highs that we made in July right here. And then we also have the bull market highs, and all of that represents overhead supply and resistance. So we must keep that in mind and understand that it could take a significant amount of work to get through all of that. The good news is this, and that is that we have an upward bias to seasonality going into the end of the year. That could help to push us closer and get us through some of this resistance. Also, there is a lot of pessimism in the market. We've looked at this in the past few weeks, the put call, equity put call data. Also, next time we meet, we'll talk about sentiment among investment professionals and the investing public, and it's generally pretty cautious. And so that really does help the market to be able, that demonstrates that there's a lot of cash latently sitting on the sidelines, that an uptrend would pull back in to the market and fuel higher prices. So there we go. Now to conclude, and let's just take a couple more minutes, and you've seen this chart before, and this is the 1960s, 1970s. This was a period of ramping inflation. Inflation is the nemesis of long-term trending bull markets. So the thing that happens with inflation is it tends to diminish the quality of earnings. And long discussion for another day, but you can see across this line across the top, this is the ramp of C.P.I. We sincerely hope that the Federal Reserve can slay the inflation monster and get us back to 2%. I think that's a big, big job. And let's hope they can do it, but also keep in mind that they could not do it back in the 60s, which led to the problems of the 70s. This is a terrible market for buy and hold and indexers because of the trading range environment and the loss of purchasing power. Back at the beginning of this chart, $100 is what you needed to buy a basket of goods. Well, in the C.P.I, by the end of this period, you needed $328 to buy that same basket. So purchasing power is diminished over the course of a recessionary period. But what I really want to show you more is this analog. You've seen this before, and I'm just bringing up all these notes so that we can just put them in there. And this was the Nifty 50 era back into this peak, which gave us that high. This is the conclusion of the really the bull market in the mega growth stocks, which are in a large trading range at this time, but they are tending to lead the market off the lows, which is good. that these are the old winners and they're coming back and they're getting much love from Wall Street now. They're doing very well today on the 14th. But keep in mind, this is the COVID lows, and this is a big rally up, just as this rally occurred back in the 60s. Then there was a sharp bear market, and that bear market could have been very similar to the one that we had here into 2022. And then we had a two-stage advance that went right up to these highs. Well, this happened to be presidential election peak at 994, Richard Nixon's first term election. And so I believe that there is a case to be made here that we could, in fact, now this would tend to change the analog here. We could do two things. This did not go to a new high, but I think we could get to a new high in here. And we could get to a new high in the 24 election year. And so I believe that's possible. I believe the Fed will get out of the way in 24 and hope that CPI stays calm throughout that whole year. I think that they believe they've done the work necessary and they did it way ahead of time. Fed does not want to look political, so they want to have a minimum of monetary decision making in a big election year. 24 is a big election year. So I believe there is a case here for higher prices from our point and figure work, also from seasonality. We will update our seasonality for 24 here very shortly because we're coming into year end amazingly. And so let's keep going with this. So far, this is all serving us quite well. And with that, I thank you so much for being here, and we will see you next time on Power Charting. Take care, everyone.